All right, good morning to everyone. Welcome, welcome, welcome. My name is Jane. Thanks for joining us this morning for Alliance of Angels webinar. We are privileged to have David Rowat from Strategic Exits up in Vancouver, BC, to come share with us why virtual companies generate more money for their founders and investors. So before we go in, just a quick word on logistics. If you are not speaking, right, we do ask that you keep yourself on mute so we have a good listening experience, a good learning experience for everyone on the session. But that said, if you have a burning question you'd like to ask David, please feel free to speak up. The best way is to unmute yourself and talk. But if you're feeling really shy today, you can also use the chat as well. All right, so I'd like to say a few words about the Alliance of Angels before we go in. So my name is Jane and I run this organization. We are a group of 140 angel investors based here in Seattle. Every year we put about 10 million into 20 companies. Most companies that are fundraising from us, they're looking for a total of between $500,000 and 1.5. Right now, typical check size is 250 to 500. We are a sector agnostic investor. However, I would say that about half of our investments come from the IT sector, about a quarter from consumer, and the rest from life sciences, hardware, energy, etc. Right? And unlike many funds that you may have encountered, we are actually a group of people, right? So if we come into your company, people will be making like $25, $50, or $100,000 checks, and they will be joining your cap table directly. So just to be very clear about the kind of investor we are. Our main hard filter is that we only invest in the Pacific Northwest, right? That is our mandate to help and support entrepreneurs in the Pacific Northwest. So if you're seeking funding for your company, feel free to reach out to me. My email is down at the bottom of this slide. Or maybe you're an investor, you join this call as an investor, and interested in learning more about my organization and perhaps becoming part of it, feel free to reach out as well. All right, and with that, I'm going to start talking, and I'm going to hand over the call to our speaker today, David.
Great. Let me get this set up in presentation mode. Good. So I hope you're looking at a screen that says "Angels make more money in a virtual company exit," something that should be near and dear to everybody's heart.
Wait, David,
So
your slides aren't up yet.
they're not. Maybe I need to share the screen first. How about that?
Yeah.
Okay, I'm looking to do a share screen, but I'm not having much luck yet. The shared screen option is not popping up for me, Eugene.
It's the green button at the bottom, right, of the Zoom call. Or you can try alternate S.
Let's try that. There, that's better. Okay, so I'll remember that trick for the next time. Not sure what's happened, but there you go. Now, let me put it into presentation mode. And there, how about now?
Looking great.
Okay, sorry.
Right.
Sorry for that brief interruption. Let me talk, introduce myself a little bit more. I'm David Rowat. As Jane mentioned, I work for Strategic Exits in Vancouver, just north of the border. I'm an engineer by training with degrees from Waterloo and UBC. Now, I confess that a while ago I went to the dark side and did my MBA at the Harvard Business School. I hope you won't hold that against me. But since returning back to Vancouver, I've spent 35 years working with technology companies in and around the Vancouver area in a variety of positions at the C-level, as an employer or as a consultant. So it's been an interesting ride for the last 30 years with 70 different companies. Currently, I'm a partner with Strategic Exits Corp. And this is a company founded by Basil Peters, a boutique investment bank. Many of you may know of the company. Our mandate is that we work only for founders and angels of technology companies to design and execute the optimal exit transaction. In fact, we sell technology companies. That's all we do. And we've had dozens of successful exits in the last 15 years. But it's more than that for us. We also like to return to the benefit of the community at large, the things that we've learned over the years to help better prepare the next generation of entrepreneurs for greater success. So we've developed a thought leadership positions and publications on many aspects of trends in the tech industry, and particularly how they affect mergers and acquisitions. You may have seen Basil's early work on early exits. He published a book by that name and really set the stage for the whole concept of early exits. And recently, I've been doing work on virtual companies, which is the focus of the talk for today. So there's a virtual company paradigm emerging. Now, you could call them virtual. Many people call them all remote companies, but essentially, virtual companies are distinct from conventional bricks and mortars companies, which may have a few remote workers. Virtual companies take remote work to the extreme. All of the employees are remote. The company exists only online. There is no physical head office. Everybody communicates electronically and digitally. And we believe on our observations, particularly over the last year during the pandemic, that virtual companies are changing the nature of work in the 21st century. So in the course of the research, I organized a collaboration with two of my alma maters, the business school and at the University of British Columbia, to do some deeper research into the aspects of virtual companies and why they're more successful. And this led to a new study at the Harvard Business School, eXp Realty and the Virbela platform, which is now being incorporated into the curriculum at HBS and also into the entrepreneurial finance curriculum at UBC. The case study describes the competitive and financial advantages of the virtual structure, and I'll be showing you some aspects of that research later on in the presentation this morning. It's quite interesting. So virtual companies, it's more than just remote work, although that's what you may have heard a lot of during the pandemic. So I want to distinguish a little more clearly the differences between bricks and mortar companies and virtual companies. So a bricks and mortar company, the conventional kind that we've seen for years, they may have some people working from home, but by and large, people work in physical offices at a headquarters somewhere. The company is investing significant amounts of money in leases and fixed assets. And here's an important point. The jurisdiction in which they can hire people is typically in the local community, roughly the maximum being the distance you can drive in an hour at rush hour. And so for bricks and mortar companies, commuting is very much a part of the day-to-day existence. Very, very different in a virtual company. Everyone is working from anywhere they want. There is no head office. There is no lease, so a lot fewer expenses, minimal fixed assets. Because everything is online, the company can hire globally the best people from around the world. And of course, when you're working from your bedroom, like I am, and like many people are, there's no commuting, and which makes a huge difference in your work style. So as a result of the structure, the corporate operating costs are lower for a virtual company as compared to a bricks and mortar company. The B&M company, typically, as we talked about, is hiring employees locally. So the cost of onshore talent is the highest in the world. And the company's spending lots of money on leases, fixed assets, and overhead. And importantly, they're also paying corporate income tax assessed by the jurisdiction in which they operate. Now, virtual companies can make better use of offshore contractors where the labor costs are lower. And in some cases, they're about a tenth of what you'd pay in the Valley for people with a similar experience. It's quite significant. Because it's virtual, the overhead costs are obviously lower. And if you organize yourselves properly, you can minimize the income taxes that you pay. So the end result is that virtual companies are more profitable than bricks and mortars companies. But it goes on from there. Virtual companies are also capital efficient. Because they have a lower expense burden, they're easier to bootstrap, easier to finance, and that brings two benefits to the company. First, the founders are spending a lot less time financing, and as angel investors, you know how much time can be soaked up by your entrepreneurs, spending half or more of their time looking for the next round of financing. A lot less need for that when there's less money to raise. And a very important point is that by raising less money, there's less dilution for the founders and angels, and we'll see how important this is when we get into the numbers a little bit further into the program. Virtual corporations are agile. They're not constrained by real estate or physical assets or financing, as we've talked about. The administrative overhead is lower. because they can be remotely managed, using Zoom, or or other means of digital communications. And so, by constant online communications, a very heavy investment in communications capability, then the company can be run manageably. You don't have to be looking at your people every day. As a result, decisions come faster, the corporate response is quicker, and agile virtual corporations can scale quickly to disrupt established industries. And we're starting to see that happen more and more often. I mentioned that virtual corporations, because they're online continuously, can hire the best worldwide talent from from anywhere in the four corners of the earth, because everybody is online. There's no geographic restrictions. And it works both ways, because virtual companies tend to be on the leading edge of the technology development. They attract the best employees from around the world, who like to come and work with other best-in-class employees doing something new and different. We were just looking at a company the other day who's looking for a potential exit. And they have two founders, one who is based in the Valley, the other who is based in London. Their chief marketing officer is in Tallinn in Estonia. The chief operations officer is in Miami, and most of the development staff are located in Kiev in Ukraine. So, this is the typical pattern you're starting to see with virtual companies hiring the best people from around the globe. Now, it's also true, and we've certainly seen this during the pandemic, that employees prefer to work virtually. They recover that completely wasted commute time and invest it with their family and other interests. They're not polluting their car when when it's sitting in the driveway. And here's a point that is particularly important for working mothers. Katie Rice and I were talking about this yesterday, that a virtual structure gives a better work-life balance to families. They can organize work around their lives instead of the other way around. And so it's a much easier way to manage various aspects of your life. Now, having said that, of course, we know that during the pandemic, this structure played havoc with many families, because the house was not just a home and a kitchen; it was also the workspace, the daycare, and and the public school, all of which was happening contiguously in the same space, which was very, very disruptive and frankly very nerve-wracking for parents. So when the pandemic settles down and the kids are back at school and there's a new normal descend, I think that the new work-life structure involving virtual work and virtual companies is going to encourage the greater participation of women in the workforce and make it much easier for them. At least I hope so. And the last point, of course, and why employees like to work virtually is that when you're working from home, you're spending a lot less money on gas, meals, and clothes. So all around, it's a pretty good deal. Now, we learned some things during the pandemic over the last 14 months, and some of it I found kind of surprising, but some of it, was fairly predictable. So, all of a sudden, overnight in March of 2020, you may remember that large enterprises, office-centric companies were forced to work from home literally overnight, and it took a while to get the infrastructure issues sorted out, but a far greater difficulty was the change in work attitudes that they had to employ in order to be able to manage people remotely. It's taken a long time, and it's been particularly difficult. So, whereas most employees are embracing the virtual advantages for the reasons we've talked about, it's taken the managers a lot longer to come on board. They've had to learn management by objectives, empowering people. They had to learn to be able to manage people without seeing them every minute of every day. And this is, I guess, what came as a surprise to me, because, I thought we'd learned the lessons of management by objectives, empowerment, engaged employees are happy employees and more productive employees. I thought we learned that all decades ago back in the 80s, but apparently there's still some places that haven't got the memo. And it's been very hard for many managers in large companies to make this adaptation to working from home and managing remotely. So we're seeing that lots of young tech companies are embracing remote work. We'll talk a little bit more about that in a minute or two. And most employees, now that they've had a year of the freedom of working from home with a flexible schedule, they want to stay working from home, or at least full or part-time. And I think we can conclude from that that virtual work is here to stay. You know, it's interesting. You may remember about a month ago, Google made the announcement that they were going to actually go back to the office, and they expected everybody to be sitting at their desks come some date in September. And I looked at that and I said, I wonder how long this is going to last. And sure enough, within 3 days, they're already walking it back, talking about some kind of hybrid model, and the ability to incorporate permanent part-time work from home if they wanted to. And my guess is that the employees by and large rebelled at Google and said, we're not coming back to the office. It's too nice working at home. You'll just have to find a way around it. And they did, and they will. And I think we're going to see more and more of that as time goes on. There is a company called remote.co that every couple of years or so interviews the best all remote or virtual companies that they can find. And the most recent work was done several months ago with 140 remote or virtual companies. And what they noticed is that almost all of the remote companies were early stage tech companies. And for most of these virtual companies, working virtually is a passion. It's part of their identity, it's part of their ID. It's what distinguishes them and makes them quite proud to be working in such a revolutionary company. So most of these virtual companies were virtual from the startup. And you see again that they invest significant amounts of time and effort in constant communications to keep everybody in the loop and part of the decision-making process, because without that, it's very easy, as you can imagine, for people to get lost at the end of a Zoom call and not really feel part of the action. So, that continued commitment to keeping people involved is very important. But luckily for early stage tech companies, this isn't much of a challenge, because these are the new millennial workers that are coming into the workplace now. And these are the people who are born with a cell phone in their hands. They've been communicating digitally all their lives. And so working in a virtual workplace is just really bringing their digital lives into the workplace. It really isn't that much of a strain or a challenge for them. And so what we drew from this, in a couple of conclusions is that it's much easier to start up a virtual company from scratch than to try and transition an office-centric company to virtual. So, once you've been virtual, you want to stay virtual. If you haven't been virtual, it's a little bit harder to get that way. But without doubt, I think there's a paradigm shift that's part of us now, part of the fourth technology revolution, that virtual companies and remote work are here to stay. So that's the first part of the presentation. And Jane, maybe we want to take a question now if there is one, or otherwise I can continue on.
There are no questions so far, so why don't we keep moving?
Okay, sounds good. I'll carry on. So I want to talk a little bit about now why virtual companies are great for founders and angels. And let's start off with the happy day when an exit is achieved. The founders sell their company to a buyer who's quite happy to bring on new people, new talent, and new technology into the company. They shower the founders and the angels with lots of money, and it's a happy day for everybody. Well, except until the government shows up, and they will take their capital gains tax, dividend tax, withholding tax, all kinds of taxes. They are very happy because they are sometimes taking between 20 and 40% of the entire value of the deal, and which in many cases makes the government the largest, biggest winner when a tech company exits. But happily, there are some things that you can do about that. Virtual companies, because they're online, can register anywhere in the world that they want to, and so they can choose to domicile themselves in a jurisdiction which has lower transaction taxes, and avoid a considerable amount of tax at the time of exit, sometimes all of it. So that's a terrific advantage, which we'll see play into the amount of money that founders and angels get to keep a little bit later. But the quid pro quo for that is that international tax strategy is extremely complex. Anytime you're doing a transaction which crosses borders, excuse me, it is a complex job to do. And that's because very few tax and M&A lawyers really understand the tax law in a foreign jurisdiction, which should not be surprising. My daughter's just completing her law degree, and the last exam she wrote a week ago was on tax, and she showed me the tax code, which was literally this deep, and that's just for Canada. You can imagine how deep it is with the ITA in the United States. Very difficult for lawyers to learn anything outside their own jurisdiction. And so what that forces the investment bankers like Strategic Exits to assemble and coordinate teams of lawyers for each discipline, whether it's the tax or the or the corporate entity, the M&A documents. They need to have lawyers for each jurisdiction, each country, and each in each specialty. And so we're in the business of coordinating the efforts sometimes of up to 6 different investment banks who are looking at various aspects of a cross-border transaction. They're expensive. You know, they clock out at, you know, several $100 an hour. So it's a very expensive bill, but it's generally worth it because they can be incredibly creative in finding ways to minimize the taxes that that the founders and other folks have to pay on an exit transaction. And it makes a huge difference to the amount of money that the founders and angels get to take home with them. There's something else that's happening out in the tech industry that we've picked up on over the last year, and I'm sure most of you have too. And that is that the antitrust review is rearing its head again. You know, the big tech companies are getting very big. In some cases, some may say that they're getting too big at this point. But what they've noticed is that one of the mechanisms they have for maintaining their growth is acquiring hundreds and if not thousands of small technology companies for their technology. So, and that's picked up the notice of various entities within the U.S. I think the Justice Committee and the Commerce Committee are looking at this. So I suspect that as big tech comes under scrutiny, the number and the size of the M&A transactions they do with small tech companies is going to come under scrutiny, which may make life a little bit more difficult. The other thing that's gaining in importance, of course, are the political and security concerns that they're growing around the leakage of intellectual property outside the borders. You know, governments want to keep homegrown technology where it started at home, and so I think that, and because the easiest way to acquire technology is to buy the company that developed it, and that has been a part of life in the tech industry cross-border for many years. But between these two, between the antitrust review and the concern about IP leakage, I think we're going to see that that tech M&A is probably going to get a little bit stickier, particularly if it's cross-border. But here's the good news: is that if you're a tech virtual company, you can avoid many of these reviews and restrictions again by domiciling your company in a jurisdiction that has fewer regulations. So you can sort of fly around the restrictions that are in place for local companies by making sure that you're an international company. So that's one of the terrific advantages of being a virtual company and its ability to relocate. So we've talked that virtual companies make founders and angels richer, and I'd like to demonstrate that with a little thought experiment and why virtual companies sell for more, and we'll show how the founders and angels get to keep more of the proceeds. I'm going to do it by introducing a formula I developed called the Founders Wealth Creation Formula, and I'll step through why it is that virtual companies do better than bricks and mortar companies. And then I'll finish off the formal part of the presentation on a case study that Strategic Exits did in selling a virtual company a couple of years ago. So the Founders Wealth Creation Formula, it calculates what portion of the proceeds from an exit transaction that founders and angels get to keep. So the formula starts with the gross proceeds that are paid by the acquirer, and then looks at the various amounts that get subtracted from that, they get paid to other investors, what gets paid in taxes, exit costs, and what's left after everybody's been paid, of course, is what the founders and the angels they get to keep. And so what I'd like to do is compare the net proceeds to the founders and angels between a virtual company at exit time and a conventional bricks and mortar company. So here's the equation, and I think most of you with finance background can probably interpret this fairly quickly, but let me just step through it and tell you what each of the terms are. So the EBITDA, obviously, I think most of you know that's the earnings before interest, taxes, depreciation, amortization, and now stock-based compensation. So it's essentially the cash flow that the company is generating, and it is the principal term that acquirers use to determine what a company is worth. They take the EBITDA and they multiply it by the EBITDA multiple, and these two, EBITDA times multiple, calculates the gross amount of the exit proceeds. This is the big pile of money that's on the table that now gets divided. So first up are the venture capitalists, which take their, let me see if I can use a pointer here to circle this a little bit easier. Yeah, there we go. So EBITDA times multiple is the gross amount of the proceeds. Now, the venture capitalists step up and take their liquidation preferences off the table. And then you multiply by the percentage of the equity that's held by the founders and angels. We'll call that F. For the taxes that you have to pay, if T is the tax rate, then 1 minus T multiplied in is what you have left after you've paid your taxes. And then, of course, you need to pay the exit costs for your advisors, the lawyers, the accountants, and those awful investment bankers. So that's the formula. We'll step through and I noticed, as we started to look at some of the mathematics around this, that it was the case that that in every single term in this equation, that the virtual companies outperform bricks and mortar companies. The EBITDA is higher. The multiple is higher. There's typically no liquidation preferences if there are no venture capitalists that are part of the investor pool. The percentage held by the founders and angels is higher. The taxes are lower, so 1 is T multiplied in is higher, and oftentimes the exit costs are lower too. And let's start to to look at why that is the case. So why is EBITDA higher for virtual companies? Well, we've talked about the fact that they're because they're hiring globally in low-cost jurisdictions, that their global compensation costs are typically lower for a virtual company to the extent that they can bring in foreign workers as part of their team. We've talked about no facility costs and lower administration costs. And because the companies tend to be agile, they can get more revenue per each employee. And so the revenue typically tends to be higher. So how much does all this account for? We're not sure, but let's circle a number of 50% as the amount that the EBITDA will be higher for a virtual company than a bricks and mortar company. And then let's look at the EBITDA multiple and why it's higher for virtual companies. Well, the primary reason is that virtual companies grow faster. And if they grow faster, they attract a higher EBITDA multiple, obviously, because the investor is going to, or the acquirer is going to get their money back faster and earn a faster return. But they'll also pay for some more subtle hidden benefits of the virtual company. The fact that you've got a top team of global talent, which means that the team is very flexible, very creative, acquirers will pay more for that. There's less distraction for funding, as we talked about earlier. So if there's more time spent building the company, that's of value to the acquirer. And again, they'll pay more for that. And other aspects of the exit transaction, virtual companies, in our experience, are easier to acquire, to integrate, and to relocate. And I won't go into those details today, but if you want to ask me a question later during the informal part, I'd be happy to share our experiences with that. So what do we think the total increases in the multiple might be? Well, let's circle 40% and see how that works into the equation. Now, I've mentioned that the founders get to keep a bigger portion of the equity, and that's because bricks and mortar companies are often raising multiple rounds of venture capital financing to fund their growth because they're investing in fixed assets, facilities costs, and expensive local employees. So in the process of raising round after round of venture capital equity, the founders and angels become significantly diluted on the one hand, and the liquidation preferences are starting to pile up on the other hand. So this is money that is not going to founders and angels. But for virtual companies, because it can be bootstrapped, as we've talked about, there's less need for the financing, so there is less dilution and typically no liquidation preferences at all. And as a result, the founders can retain a significantly larger portion of the equity. And so we say it could be 50% versus 20% for a bricks and mortar company. We've talked about how virtual companies can avoid some of the transaction taxes. Bricks and mortar companies are going to pay the taxes on the transactions, dividends or capital gains, whatever the jurisdiction applies, which can be up to 20 to 40% of the total transaction price. I'm going to pick a number of 25% because I think that's a typical amount that people budget in for taxes when they're doing an exit. But virtual companies, because they can incorporate in a tax-friendly zone, can often pay no transaction taxes at all. So let's try and throw some numbers at this and see what the difference is between a bricks and mortar company and a virtual company, and in a simulated thought experiment like this. Suppose we start with a bricks and mortar company that has an EBITDA of 15 million and a multiple of 5 million. Gross proceeds multiplied to two together, you get $75 million. Look how much better it is for a virtual company. The EBITDA, we said, was 50% greater. The multiple is 40% greater. Multiply all that in, and you get gross proceeds of 158 million, which is more than double what a bricks and mortar company enjoys. So you see right out of the gate that virtual companies, generate more money for their founders and their angels just by being a virtual company and all of the advantages that come to it. But look how much better it is for the founders and angels. If you recall the numbers, we said let's assume that the bricks and mortar company through the rounds of financing has accumulated liquidation preferences of 3 million, which they have to pay off the top. The founders and angels have been diluted to 20% of the equity. The tax rate is 25%, and let's assume the exit cost to pay the lawyers is around $1 million. Plug that into the equation, and founders keep, just a little under $10 million, which is not a bad payday, I suppose. But look how much better it is for the virtual company founders. No liquidation preferences. They keep 50%. There's no transaction taxes if they're located offshore, and the exit costs are a little bit less. So plug that into the formula, and the founders and the angels are taking away 78 million. That's 8 times higher. That's that's a significant difference. Frankly, it shocked us when we started to push those numbers around. And I'll have to admit out of the gate that probably these numbers are a little bit aggressive for 2 reasons. But not every virtual company has all of the advantages listed. I mean, you may not be domiciled offshore, for instance, or you may have a higher portion of onshore talent than offshore talent. Each company is a little bit different, and so they may not be able to enjoy all of the advantages to the extreme. Many of these advantages are overlapping, like the strength of the team affects both the EBITDA and the multiple. But all that said, based on the experience we've had over the past several years in selling several virtual companies, we believe that the exit price is 50 to 150% higher, and that the founders are earning 100 to 300% more. So a terrific deal that virtual companies are worth more at exit time, and the founders and the angels get to keep more of the proceeds. Now, I want to draw your attention to some of the work we did when we were working with Harvard and UBC in looking at some of the numbers that play out here. And we found 2 companies that were almost, perfect comparables for each other. EXP Realty, which is a real estate brokerage company, a virtual one, and it's very active in the Pacific Northwest. So this may be a company that some of you have run across. Or its chief competitor, Redfin, which is a bricks and mortar company. And as we these are both public companies, so we were able to get the financials from their public listings. Excuse me. And it was interesting what we found. EXP was founded in 2010, about 11 years ago. Redfin's been at it for 17 years. They've had longer to grow their business. EXP generated revenue last year of 1.8 billion, whereas Redfin had less than half of that. So EXP has become bigger than Redfin in a very short period of time. And I can tell you, although not all the numbers are here, that most of that increase has happened in the last couple of years, meaning right through this pandemic stage. EXP grew 83% in 2020. It grew 100% in 2019, whereas Redfin slowed from 83% 60% in 2019 to 14% last year. So its rate of growth is slowing down compared to EXP. Interesting, virtual companies do grow faster. In terms of profit before tax, EXP had their first profitable year in 2020. Redfin did not. In fact, looking back over the years, the 17 years it's been in existence, it has never generated a profit in any year, period. It's just never been profitable. Looking at the adjusted EBITDA, Redfin has finally scraped together a positive cash flow year, but EXP is far and away ahead of it. Now, interestingly, and we scratched our heads over this one and talked to EXP CFO on this particular one and why the valuation of EXP was lower than that of Redfin. And the reason is that Redfin has had a very active investor relations program for years and years, and they have a good institutional and analyst coverage, and so there's a great market for their stock. EXP, until recently, has never bothered with investor relations. Their reason for being public was to allow their employees and brokers to enjoy some of the upside potential of the increase in the stock price. So they didn't invest in an investor relations program, and that, as a result, they haven't had the same attention from investors and institutional investors that Redfin has, so they've paid the price in terms of valuation. But look at these last 2 rows, and this is what we found really fascinating. EXP has only raised ever in its life, $750,000. And they only did it because they promised some friends that they were going to go public and they'd be able to buy some shares. Otherwise, they wouldn't have needed to do it at all. But look at Redfin, $700 million. So they've had to raise round after round of equity and debt financing to fund the continual series of losses since their founding. So a lot less financing raised for a virtual company. And again, look at this last component here. The founders still own 57% of EXP, even though they're a $4 billion company with revenues of 1.8 billion. Whereas Redfin lost their founders a long time ago. They don't own any of the company, and I think the management team owns less than a couple of percentage points. So what this comparison showed to us is that the observations that we had kind of made parenthetically over the years and the research that we had been doing over the past year, does demonstrate a few things about virtual companies. They grow faster, they're more profitable, they raise less financing, and the founders retain more of the equity. So, here's a case that that I think proves that, what we were saying probably is on the mark. And I'd love to see some more research done on other comparable companies to see if it holds true, particularly in the tech industry. And, I emphasize EXP and Redfin are not tech companies, they're real estate companies that use a lot of technology, but they're not like most virtual companies that we've come to know and appreciate. Anyway, so the implications for entrepreneurs and angels, now that you've seen some of the advantages of being virtual, if you're looking to start or finance your next company, are you going to look at a bricks and mortar company or a virtual company? I think this is the reason we're going to see more and more virtual companies formed in the next few years, and why we think that virtual companies are part of the new paradigm in business. So I mentioned that we do thought leadership and publish articles for the benefit of the industry and the community. So there are dozens of articles that are published on this new area of virtual companies, covering remote work, the advantages for virtual companies, as we talked about this morning, and why they sell for more, and the founder's wealth creation formula. And you can find these on strategicexits.com's blog at exits.com/blog, and also on the LinkedIn profiles for Strategic Exits and my own personal LinkedIn profile. There's dozens of articles if you're interested in learning some more. So Yi-Jane, are there any questions yet?
There is a question from David Hewer, right, in the chat. David wants to know if you can recommend a list of countries with the lowest regulations.
That there are dozens of people who write on exactly this topic, and so you don't have to search very far into the internet to find a list of the countries that have friendly tax jurisdictions and various ways and means that you can take advantage of them. So we're not specifically in that business, so I won't comment further than that. But it's the help is not far away, if I can leave it there.
Well, it's not British Columbia, I can tell you.
Well, you and I both know about that.
Yeah. Thank you.
Okay. So, was there any else, Eugene?
Yes. My name is Brad Chulu. David, can you hear me?
I can hear you, Brad. Yes, and I can see you over on the side too.
Great, certainly. So I live in Seattle, and I've got a business. We've started up a startup company. There's two of us. My partner's in California. And it's an online business that we're building, and we're in the LLC mode. Beginning of next year, we will transition to being a C Corp. So the issue then becomes, of course, where should we domicile? Like which state of the US, presumably, should we incorporate, and then where should we have a like a head office, which I don't think we should, but I'm not quite sure. Should we have a business office still, or a post office box, or whatever for the company? You understanding the drift of the question?
Oh, I do. It's one I've seen before. So I need to preface my comments to say I am not a tax expert, and I'm certainly not a U.S. tax expert, because I'm based in Canada. So I'm loath to try and give any tax advice. But
yeah, I get the warning.
Yeah, So I will tell you that that the founder of EXP Realty tells me that he has a post office box somewhere in Bellingham that he has not visited in years. and they only have it because they need for, services of legal documents. Sometimes you need to actually have a physical mailbox that you can be serviced at, and that's the only reason that they have it, because everything else happens online with no physical head office at all. If that helps answer some of your questions.
Certainly, but I think also. Oh, sorry, I'll let you finish.
Yeah, and from my knowledge of the U.S., which is not deep, I'm afraid, but I do know that lots of companies are headquartered in Delaware. The Delaware LLC is a very commonly used tool. There are lots of companies. I domiciled once many years ago in Nevada, and I think that there are many virtual companies or offshore companies that are located in Nevada. Something you might want to go and take a look at.
Sure. Okay. Look, thank you very much.
Sure. Jane, anything new? Sorry.
It's a question from Praveen. Praveen Vashni. Sorry if I got his name wrong. Any advice, converting a existing traditional business to something that's more virtual?
Yeah, it's. I will say again, not being a tax expert, I can't give tax advice, but I do know that it is an extremely complex process to sever your ties with Uncle Sam and try to set up shop somewhere else. And that's not something that we have ever done in strategic exits. We've started with virtual companies and sold them, but I don't think, at least not during the time that I've been there, have we ever had a case where we've had a domiciled U.S. company and then taken it offshore. We've never, to the best of my knowledge, we've never done that. And I think it would be exceedingly difficult, but that's where you need to go and get some of those expensive tax advisors that I was telling you about earlier in the presentation. If there's a way, they will find it.
David Rowat here again. So doesn't it ultimately come down to the decision where a virtual company domiciles is to the investors? I mean, where would an investor prefer the company to be in?
Well, maybe in the less formal part of the presentation, when more people can join in. I think there's probably 50 angels on this call. I'm sure that some of them have had this experience, and they could probably share some of their war stories with you.
This all seems to beg the question: where's the recipe? Where's the strategic startups? The analog to your strategic exits? How is the curious founder to avoid missteps?
Get good advisors. That's the simplest thing. And, I can talk a little bit about investment bankers. I mean, we have, helped several virtual companies to exit. Those were cross-border transactions in some cases. They were U.S. companies in other cases. I can't tell you all of the tax in and outs of this, but again, to repeat the advice that I gave before, this is a very complex area where you need the best tax advice, and I cannot and don't pretend to give it to you. But if you do some poking around, I'm sure that you'll be able to find the tax advisor who went down this path and can help you do it. As I said, on the internet, you don't have to look very far before finding a place to start looking for the answers to your questions.
But do you think, I mean, can you look at, are there, in your experience, have you found, articles written, here's what we did, lessons learned?
Well, we did some of them for sure. And unfortunately, because of the NDA requirements, there are very few companies that can actually explain, what the nature of the transaction was. There are a couple of case studies on our website, which you can go and take a look at. We don't get into the intricate details of the taxation treatment, because that's really, proprietary to our clients who want to keep it that way. So we don't talk a lot about that. But if you're looking for case examples, again, I point you back to the internet, and within a few hours of poking around, I think you'll be able to find a lot of the answers to those questions.
Interesting. Thank you.
Okay.
We have a long question from Jay. Hey, Jay, do you want to just ask your question? Do you want me to read it or?
Sure. Basically, so as a virtual company in Washington, there's all kinds of work that needs to be done, and not all of it can be easily packaged as contractor work with a contract and a deliverable. But a lot of stuff just needs to be done by employees. We've got that flexibility. Washington, as I understand it, has really cracked down on the use of contractors for such versatile employee work, especially after Microsoft abused using contractors as permatemps for so long. So every time we hire someone outside Washington state, we've got to go register in another state. We've got to get a registered agent in that state. We have to get some sort of a tax nexus so that we can have employees there, register with LNI, employment security, set up lots of stuff, and then keep supporting it. It becomes an accounting nightmare as we add ever more employees around. It would be great to not have to do that, but at the same time, we want to comply with the concept of they are employees. So virtual seems to be great in many ways, but are we doing something wrong? Is there some better way to do this, or should we just domicile in another state where they haven't been abused by Microsoft yet?
Well, in a previous life, I was a chief financial officer for a software company based in Vancouver, but had what they call a permanent establishment in the U.S. And the kind of challenges that you're relating here were ones that we had to deal with every day. We had to be very careful about where we sent people to trade shows, because some states, if you actually put feet on the ground, even if you had no permanent establishment in the United States, the fact that you put feet on the ground to attend a trade show may be meant that if you subsequently sold something, and I can't remember all the details here, but all of a sudden you triggered state sales tax. And state sales tax, I think, is probably the bane of everybody's existence. Certainly, it is for Canadian companies trying to sell into the States, because they have to either get a tax exemption certificate, or they have to remit state sales tax every place they ever sell anything. It's a horrible thing. Now, virtual companies, again, different states treat things differently, and you'll have to investigate to see whether, domiciling in a different state is going to solve your problems. But while you're at it, why don't you check out to see if you were to hire a contractor outside the United States, whether you might be able to comply with all of the rules within the United States, yet end up spending a lot less time on administration, and maybe less time on the employment costs.
One other downside I've discovered is at a bricks and mortar company, when people go on vacation, they tend to go on vacation. And so they may be going to other states for recreation, but they're not taking work with. I've noticed very often as a virtual company, when people go on vacation, they take their work with them. And so they will do a few days at Disney World, then they'll work a few days down in Florida, because they can work anywhere. Their laptop goes with them. And so suddenly I've got employees working in states all over the nation, depending on where their family and vacation destinations are, and they're working there. Now, the nice thing is our time tracking system will actually keep track of the GPS coordinates when they clock in and clock out.
There's no hiding.
But it makes, yeah, I know there's no hide, but yeah, but at the same time, it makes for a reporting mess. And it seems like that is a disadvantage of a virtual. I mean, we could clamp down on it, but that's part of the appeal, why they work for me, is that they've got that flexibility.
That's a new one to me. I haven't heard that one before, so thanks for letting me know. I mean, the fact, I mean, you don't have to be a virtual company to have people working on their vacations. Heaven knows I did, and I'm sure many people did for many years, is that they'd be, employed at a head office, but taking their laptop and their tablets with them and working from the beach. Heaven help us. So I suspect that problem is not new to virtual companies. It's a fact of the taxation patterns within the states of the United States. So I guess as the founder, as the entrepreneur, you're juggling a couple of things: the extra productivity that you get from having people work their vacations versus the extra administrative hassle. But I'd look at it from a completely different point of view. And this is just my personal opinion. It doesn't reflect Strategic Exits either. Is that vacations are there for a reason. People need to rest. They need to turn their brains off and just watch the waves lap on the shore for a period of time. And in fact, you really are not really on a vacation even if you've left the office, until you get to the point where you actually throw the cell phone to the side and say, whatever it is, it's going to wait because I'm on vacation now. That's at the point when you're really starting to rest and recover. And so, from a founder's and a manager's point of view, you could make it a rule that you can't take your laptop with you, and you can't answer phone calls, you can't answer emails, and only in an emergency. And that means your boss is the only one with your cell phone number, and can phone you only in an emergency. Otherwise, you're on vacation, you're out of touch. And in one case, one of the first companies I worked for many years ago, we had one guy that had just driven him to the R&D manager. Funny that he had worked so hard trying to get projects out the door that he had driven himself into a state of exhaustion. And so we literally, took his car keys. We drove him home, took his car keys, shut off his computer, and he still had a second pair of car keys that he used to try and get back to the office. I mean, it was ridiculous. But here was a case in point that people need their vacations, make sure that they take them, and maybe that's the way that you indirectly solve your other problem. Jane, should I continue with the last part of the presentation?
Yeah, please go ahead.
Okay. So I'd like to give you a case study of a virtual company that Strategic Exits sold a couple of years ago. This is a data analytics company. They found an unexploited niche in the growing field of data analytics, and found a solution that solved a significant problem for an awful lot of people. Now, this company was founded by a millennial digital nomad. He called himself Airbnb's best customer, and I'm sure he was, because he and his wife would fly literally every 4, 5, 10 days from from some city to another city. They'd set up shop, plug into the high-speed internet to wherever they landed, and they would manage the company from there. And we would connect with him on a Zoom call. And I was working on this one with Basil Peters, and we'd have a little game between us, looking at the background behind his head to try and figure out if he changed location and where he was at that particular point in time. He had no fixed address. He literally was a digital nomad flying the earth while running his company. He had no formal training. He was self-taught in software, but obviously a very, very smart guy. He bootstrapped his company completely from the money he had in his pocket when he graduated with a degree. He had some money left over, and with that, he founded the company, and it became profitable very, very quickly. So he never needed to raise a nickel of external financing. He completed the software development and launched his company within a year, and he grew to 40 employees within 3 years. Now, he's paid particular attention to how he built his team. He made sure that he hired in senior positions other experienced digital nomads, folks that had been around the track a couple of times. They knew what they needed to do. They didn't need a whole lot of supervision. Essentially, they were intelligent, competent self-starters. When it came to his developers, he only hired elite developers. If you couldn't prove that you could crack top code within a week, you were probably gone. Tough place to work. But that made sure that he had the best committed and talented people. People had to be committed to the virtual work culture, something I talked about a little bit earlier, that people working in virtual companies need to be evangelists for the virtual work style, so that they can enjoy all of its advantages, and overlook some of the disadvantages, which we really haven't talked about, but the fact of essentially working by yourself for long periods of time. So hiring very smart, very self-starting workers, responsible, accountable, low oversight. This was the key to the team that he put together that was able to grow a company very, very quickly with very little money. Now, after all of 2 years, he decided the company was quickly growing, highly profitable, and it was time to take some money off the table. So we went looking for an investment bank to help him sell the company, and he found us online, naturally. And he picked Strategic Exits for what we think are 2 reasons. One is that all of us in Exits have decades of operational experience in tech companies. It's all we've really ever done. And we've been at it for decades. And we also had experienced with virtual company exits before, as I mentioned. So we had walked in his shoes, and had done what he was trying to do. So there was a level of comfort there that I think was particularly important in developing a strong relationship between the client and the company. And so we were able to execute pretty well on the exit. So we went to work. We do what we typically do. We found multiple acquirers for the company, and one in particular stood out. he was drawn to the company right away, from the first introduction, because they knew the specific data analytics space that they operated in, and they felt that they'd be able to help the company with the other investments that they made. And they particularly liked the strength and the capability of the team, and the fact that the company was growing at lightning speed, and had already within 2 years made an impact in a very large market. So they basically said, what's not to like? And they perceived a huge amount of value, and they said, we don't want to have to go through the typical M&A process. What if we placed an offer of this? And it was a pretty attractive preemptive offer, and we advised our client it would be a good idea to take it. We didn't think that anybody would exceed it, and so we accepted the offer, but with the stipulation that the letter of intent was signed with a commitment to close in 60 days. And for those of you who have been through ECITs, and which is many of you I suspect, that's a pretty tall order to expect a 60-day close. But as it turned out, it really wasn't that much of a challenge. The due diligence was relatively easy because it was a young company. There weren't very many records to that point in time. All of them were electronic, and so we were able to assemble a virtual data room and review all the documents within a couple of days. Those of you that have done exits for bricks and mortar companies that maybe a little bit longer in the tooth knows that the diligence phase can often run into months, as you're piling through dusty old filing cabinets looking for old contracts that, can be a very arduous and expensive process. But in this case, electronic, very well organized, it went through without a hitch. Now, the thing we were worried about in this transaction was the site visit, and typically, the site visit is a key moment in the M&A process that you plan for, scrupulously, so that every conversation, every interaction is carefully planned to put the company in its best light. We're saying, well, how are we going to do, a site visit when there's no head office to visit? There's nothing to see. It's all in cyberspace. So we did the next best thing. We brought the buyers, the diligence team, and our management team, and we found the city that had the greatest density of employees, and we moved everybody there for a few days. This was obviously pre-pandemic, and we holed up in a hotel room to for the buyers to meet the people in person, do all of their diligence questions. But the most important thing as we reflected on later is that the informal dinners and lunches where they could talk, casually as people, that was essential to assess that the teams were going to be compatible and able to work together, and it was a key feature in bringing the deal to close in as quickly as we did. So in managing the transaction, this was a cross-border deal that involved 3 countries, not just 2. So we knew we had to work particularly hard to assemble a strong exit team of advisors. So we chose the M&A counsel with cross-border experience. We had an international tax strategist who plotted the way to organize this for tax efficiency, and then we had tax lawyers in 3 different jurisdictions papering the deal over. It was very complex, and it broke some new ground, actually, which oftentimes you do when you're doing a cross-border transaction. There was 100 documents, hundreds of documents to close the transaction, and with a week to go before a deadline, there were dozens that still had not even been written, let alone reviewed. And I really did not think that they were going to make the deadline, but they worked bloody hard. And when the smoke cleared, they did it. They did it on time. In fact, they did it early. The virtual transaction closed in 40 days. So we think that's it's a pretty big accomplishment for for a company like this in 3 different jurisdictions. So if we look at what were the components of the successful sale here, from at least from our perspective, one is that we had a company that was bootstrapped with no external investment, made it easier. They had developed and launched their global data analytics application within a year, so obviously a very capable team. Rapid growth in revenues and profits, and they were successfully sold in their 3rd year, which we think is pretty significant. And if anybody wants to guess the transaction value, it was 125 million, which is not bad for a 3-year-old company with 40 employees, all of whom were virtual. So to us, this was a prototypical case of a good exit of a virtual company. And So when we look at this, the things that made this possible is that because it was a virtual company, the exit price was higher right out of the gate. We had a team that in the company that worked hard, elite employees that were hired for their work ethic and their adaptation and to the virtual work style. And we also had a world-class exit team, including the lawyers, the strategists, and the accountants that pulled all this together. And we needed competent people in every one of those jurisdictions to make this complex deal pull together. But we did it, and we did it in record time. And I think it serves as a model for other virtual company exits that will come down the pipe. So the takeaways from this presentation, I hope you've gained some knowledge about why virtual companies sell for more money and why the founders and the angels get to keep more of the proceeds. So let me end there, Eugene, and we're wide open for questions.
Thanks. Thank you very much. So does anyone have, there's a quick question from Jay. Could you share a little bit about how many virtual company exits you have done?
Several.
Okay. Right. Thank you. And we're actually at time right now, so there are no further questions. I'll just like to make a couple of logistics comments. These were folks that asked other questions. So the presentation will be available. We'll be uploading this up to YouTube, right? The Alliance of Angels YouTube channel. So take a look out for that. You'll be able to see the full recording. And I think the best way to get the slides would be to email David, right? So otherwise, if you sign up on our Eventbrite, Katie will be sending out the slides. Okay, so there's a couple of logistics things. And with that, I'd like to thank David for spending this time with us, sharing all his advice and his insights and his analysis and his case study. Thank you very much for doing that.
Well, Eugene, thanks for having me. It's a great pleasure to come and speak to the Alliance of Angels. It's a well-known angel group. I feel honored that you've invited me. And if there's any further questions, you've got my email address and my phone number right there. So I'm in the Pacific time zone, just like most of you. So it's easy to get a hold of me, and please feel free to call. I'd be happy to chat with you.
Wonderful. Hey, thanks to everyone, and have a great rest of the week. Thank you.
Thanks very much. Bye for now.
Goodbye.